I want to start today with a bit of a mental exercise. I want you to just close your eyes for a second.
Okay.
Picture a hotel, but not just any hotel. I'm talking about a massive, iconic Las Vegas mega resort.
Thousands of rooms, casino floor, the whole works.
Exactly. Now imagine taking 1,000 of those rooms and just locking the doors.
Taking them completely off the grid.
Completely off. No guests, no room service, no one playing slots. Just construction dust and quiet hallways every single day for a whole year.
For most businesses, that's not a strategy. That's a bankruptcy filing. You're basically cutting off your own oxygen.
Right. But for MGM Resorts International, that wasn't a crisis in 2025. It was a renovation plan. And as we look at their newest numbers, that decision is actually the key to unlocking what just happened.
And what happened was, well, it's a huge deal. It's a story about financial engineering, changing consumer habits, and honestly, a pretty big gamble that seems to have paid off.
So, welcome back to the deep dive. Today is Sunday, February 8th, 2026, and we are breaking down MGM's Q4 2025 earnings, which dropped just a few days ago. And look, you might be thinking, okay, earnings reports, spreadsheets, why do I care?
Sure. Right.
But our mission today is to look past the stock ticker. We want to understand the state of the experience economy right now, here in early 2026.
Because MGM is really a proxy for the consumer, isn't it? Are people still spending? Are they still flying to Vegas? And maybe more importantly, who is still flying to Vegas?
That who is the million-dollar question. But first, we have to look at the headline numbers because they genuinely surprise Wall Street.
And they are not easy to surprise. They missed the mark here.
Way off the mark. The expectation for earnings per share EPS was about 64 cents. That was the consensus.
Yeah, about that.
MGM came in at $1.60.
I mean, that's not just a beat. That's a different area code. That's nearly $1 difference per share.
And revenue came in at $4.61 billion, which beat estimates by almost $200 million. So right away, it feels like the narrative that the consumer is tapped out is maybe a little off.
It's definitely not crashing, but it is shifting. And I think that's the real nuance here. This wasn't just a lucky quarter. This is the result of a diversification strategy they've been building for years. You have like 3 different engines.
Okay, what are they?
You've got Las Vegas, the mothership. You've got Macau, the growth engine in China. And then you have the digital arm, BetMGM.
And for the first time in a while, they're all firing at once.
All working in concert. Usually one's up while another's down. This time, everything just clicked.
So let's unpack that first engine, Las Vegas. The big word in the report was stabilization. Now, I have to be honest, when I hear a CEO say stabilization, my alarm bells go off.
It sounds defensive.
It sounds like things aren't great, but at least they're not on fire anymore.
It can sound that way. And look, if you just look at the raw data, Las Vegas EBITDA was actually down about 4% year over year.
See, that sounds like a loss. If I tell you my salary stabilized because it went down 4%, you'd tell me I took a pay cut. Why is the market treating this like a win?
Well, context is everything here.
Yeah.
You have to remember what 2024 was. That was the year Vegas hosted the Super Bowl.
Right, an absolute anomaly.
It was an anomaly. Pricing power was through the roof.
Mm-hmm.
So comparing 2025 to 2024 is just not a fair fight. The comps, the comparables, were incredibly tough.
So 2024 was the outlier.
Exactly. But the bigger factor, and this goes back to your intro, is the renovation at the MGM Grand. We just say renovations, but think about the math. They had between 700 and 1,000 rooms offline per day for most of 2025.
I was trying to calculate that. It's not just the room rate you lose, right? It's the dinner that guests didn't buy, the show they didn't see.
The blackjack hands they didn't play.
Yeah.
Precisely.
Yeah.
Management put a number on it. They said the renovation cost them about $65 million in EBITDA for the year.
Wow. That's just profit that vanished because the inventory wasn't there. But here's the turn, and this is why the stock jumped. Those rooms are back online now.
They are back. They're brand new, and they can charge a premium for them. So that headwind from 2025 instantly flips into a massive tailwind for 2026. They took that pain to get the gain.
Okay, but underneath that stabilization story, there's a dynamic that I found really interesting, maybe even a little concerning. It's this massive split between the luxury customer and the value customer.
Oh, yeah. This is one of the most important economic indicators we have right now. It's the K-shaped recovery playing out in real time right on the Strip.
Break that down. What are we seeing at the high end?
The high end is on fire. Their luxury properties, Bellagio and Oya, they actually saw a 7% increase in EBITDA. They mentioned their holiday gift shop event for high rollers.
The invite-only thing.
Yeah, at its second highest performance ever. The wealthy are still spending, and they are spending a lot. They're price insensitive.
But then you walk down the street to, say, the Excalibur or the Luxor.
Totally different story. The value segment is seeing softness. The CEO is surprisingly open about this. The customer looking for a cheap getaway, the family on a budget, they're pulling back.
They're feeling the pinch of inflation.
Inflation, interest rates, all of it. They're just deciding to stay home. It's a tale of two cities on one street.
And it seems like MGM's strategy is pivoting to chase that money. They're doubling down on luxury.
Of course. That's where the growth is.
Which brings us to this concept of the golden triangle. I saw this phrase a few times. What is that?
It's all about asset density. The Golden Triangle is the three major venues: Legion Stadium, T-Mobile Arena, and the MGM Grand Garden Arena.
And MGM's properties are clustered right around them.
Exactly. It's a capture strategy. When an event happens at one of those places, MGM just catches the overflow by being next door. It reduces friction for the customer.
And the calendar for 2026 is stacked. They mentioned Formula One is coming back.
Which is massive for them. F1 in Vegas isn't just a race. It's a luxury takeover. Ticket sales at the Bellagio Fountain Club, which cost thousands per person, are a huge driver.
And then there's the World Cup coming to North America.
With matches in LA. And you might think, how does a game in LA help Vegas?
Proximity.
Proximity. International tourists fly in for the match, then it's a short hop over to Vegas for the party.
Plus, conventions are back. They mentioned something called ConAg.
The construction aggregate show. It sounds dry, but it's a beast. It only happens every 3 years.
And they're expecting, what, 140,000 people?
140,000 attendees.
Yeah.
That fills all the midweek rooms, which lets them jack up the rates for the weekend leisure travelers. It's all about yield management.
So Vegas is the steady ship. But if Vegas is steady, it sounds like MGM China is the rocket ship.
Crushed it. That was the
Right.
direct quote from the CFO. You don't usually hear CFOs talk like that unless the numbers are just undeniable.
MGM China just crushed it.
And they did. Net revenues up 21%. Adjusted EBITDA up 31% to a new Q4 record. But the stat that really matters, the one that made analysts sit up straight, is market share.
They hit 16.5%.
16.5. Now, for anyone listening, that might sound small.
Yeah, 16% of a pizza isn't much.
Right, but you have to remember who they're up against. Sands, Galaxy, these are giants with way more rooms. For MGM to capture over 16% of the entire market means they are punching way, way above their weight.
So they're making more money per room than the competition.
Exactly. They are winning that premium mass customer. And because of that success, they pulled this move that was just brilliant corporate maneuvering, the branding fee.
I saw this. So MGM China is a separate company, but the U.S. parent company owns most of it.
Right. And MGM China pays the U.S. parent a fee just to use the MGM brand name. Well, because China's doing so well, the parent company renegotiated that fee.
They doubled it.
Doubled it from 1.75% of revenue to 3.5%.
So they just doubled the rent on their own company.
Pretty much. And that little percentage tweak results in over $50 million of incremental cash flow back to the U.S. parent every single year.
That is basically free money for the home office.
Pure margin. And it just proves the power of that brand globally.
Okay. Engine 3. Digital. BetMGM. For years, this was the problem child. The cash incinerator.
The land grab phase. They were just setting money on fire to get customers.
But that stopped. They executed a turnaround of nearly $470 million in EBITDA in 1 year.
Think about that swing. From losing huge amounts of money to a nearly $500 million positive swing. And they didn't just break even. They actually cut a check to the parent company.
A $135 million distribution in a Q4.
That's a huge psychological shift for investors. For 5 years, it was, when does the bleeding stop? Now we have the answer. BetMGM is no longer a startup with an allowance. It's a grown-up business paying its own bills.
And their guidance for 2026 says this isn't a fluke.
No, they're projecting $300 to $350 million in EBITDA this year, targeting $500 million in 2027. And they're looking outside the U.S. now.
The Brazil launch. That seems huge.
Partnering with Globo, the media giant down there. It's a very smart play. Brazil is a sports-crazed nation. By partnering with the biggest media player, you get instant credibility.
So all three engines are firing. But I want to zoom in on something a little nerdier, a small detail that I think signals where hospitality is going.
The tech stuff.
The digital check-in. Usually when companies talk about tech efficiencies, it's just buzzwords, but this was tangible.
This was the aha moment on the operations side.
They said digital check-ins increased 18%. But here's the metric that matters. If you check in at the desk with a person, it takes about 6.5 minutes.
Which feels like forever when you just got off a plane.
Exactly. But if you use the app or the kiosk, it takes 1.5 minutes.
That's 5 minutes of your life back. And for the guest, that's huge. But now flip it to the business side. Think about the labor cost.
Right. If you can process guests that much faster, you can manage your staff much more tightly.
You don't need 20 people behind the desk on a Tuesday afternoon. That's how they kept expense growth to low single digits. It's the Amazonification of the hotel lobby.
And all that efficiency means they're sitting on a pile of cash, and they're placing some very big bets on the future.
The biggest one being Japan.
MGM Osaka.
The whale.
It's a massive project. They've broken ground. 20% of the foundation piles are in. When this opens in 2030, it's expected to be the world's largest integrated resort.
The scale is hard to wrap your head around. But what struck me was the financing. You'd think building this would be terrifyingly expensive with current interest rates.
It would be if they were borrowing in US dollars. But they're not. They're using a yen-denominated credit facility.
Because interest rates in Japan are still near zero.
Exactly. It's a natural hedge. They'll earn revenue in yen, they borrow in yen. It's incredibly cheap financing for a massive project. So that's 2030. Dubai is 2028. But there was one little blink and you'll miss it comment in the call I have to ask about. National Harbor, Maryland.
The Sphere rumor.
Yeah, the CEO dropped a hint about a Sphere coming to Maryland.
This is fascinating. We know what the Sphere did for Vegas. It changed the skyline. It went viral. It became a destination in itself.
But Vegas is Vegas. Putting something like that in the D.C. area near their National Harbor property, that seems aggressive.
It is, but think about it. Hornbuckle said it could deliver a couple million more customers a year to that property.
A couple million.
That is a game changer for a regional casino. Regional casinos are usually just for locals. You put a Sphere there, suddenly you're an entertainment destination for the entire East Coast.
It transforms a local stop into a national attraction.
That's the play. They're constantly looking for that next hook.
So bringing this all back, why does this matter to the listener? We have a stable Vegas, a booming China, a profitable digital arm. What's the big takeaway?
It matters because of what they're doing with the profits. This is the shareholder value part. In Q4 alone, they repurchased $500 million of their own stock.
That's a lot.
But look at the 5-year trend. This is the stat that blew my mind. Over the last 5 years, MGM has decreased their total share count by almost 50%.
Wait, hold on. They've bought back half of the company.
Essentially, yes. Think of the company like a pizza. 5 years ago, it was cut into, say, 16 slices. Today, it's cut into 8. If you owned one slice then and you still own it today, your portion of the pie has doubled.
That explains the huge EPS beat. It's not just that earnings went up. The number of shares went way down.
Precisely. It drives up earnings per share just by shrinking the denominator. It shows they're disciplined with their cash. They're returning it to the owners.
So it's the story of resilience. They took their lumps with the renovation, and now they are a cash-generating machine.
They've had the cash to build in Japan, expand in Brazil, and buy back their own stock. It's a very, very strong position to be in.
It is an impressive turnaround, but I want to leave you with a thought that's been nagging me, going back to that luxury versus value split in Vegas.
What's on your mind?
Well, if the casinos are doing better than ever by focusing almost entirely on the luxury customer, the premium mass, the people buying $5,000 F1 tickets, and the value customer is fading away.
Yeah.
Are we seeing the end of the cheap Vegas vacation? If the business model works better without the budget traveler, where does that leave the average family? It seems like MGM is betting the house that the future belongs exclusively to the big spenders.
And so far, that bet is paying off.
It certainly is. Something to chew on. That's all for today's deep dive into MGM's massive comeback. Thanks for listening, and we'll catch you on the next one.